Dear friend, welcome back to Bedtime Story Tales, the channel that shares practical knowledge, strategies, and secrets to help each of us build a solid financial foundation toward freedom, happiness, and wealth. If this is your first time visiting the channel, remember to click like and subscribe so you don't miss the valuable videos I'll be sharing in the future. One small click today could be the first step that brings you closer to your journey toward financial freedom. Have you ever wondered why some people, after just a few years of working and investing, can comfortably enjoy life, while the majority still struggle endlessly in the cycle of bills and expenses? Why do some people, starting from nothing, manage to buy a house and build a stable passive income after just 5 years, while others remain stuck, or worse, fall deeper into debt? The answer isn't luck. It lies in choices, beginnings, and most importantly, timing, the moment you take action. And believe me, the best time to invest is right now. Imagine this scenario. You have a small amount of capital, maybe $400, $800, or $4,000 USD. If you let that money sleep in your bank account, in 5 years it will still be the same, or even worth less because of inflation. But if you start learning how to invest, learning how to make your money work for you instead of you working for money, then in 5 years, that number could multiply many times over. You'll no longer have to worry about bills, rent, or living expenses. Instead, you'll have a steady stream of passive income flowing into your pocket every day, giving you the freedom to choose how you live, how you work, and how you enjoy life. Financial freedom isn't a distant dream. It's real and achievable if you know how to act correctly starting today. But the problem is, most of us procrastinate. We wait until we have more money to invest, more knowledge to start, or a more stable market to join. The result? Year after year, opportunities pass us by, and we stay forever at the starting line. Meanwhile, those who dare to act today, even with small capital, are the ones who reap great success in the future. Because they make use of the most important factor in investing: time. You don't need a lot of capital. You don't need to be a genius. You just need to start early and do it right. Time is your most loyal companion, and your secret weapon that helps the rich get richer. You've probably heard of the power of compound interest. Albert Einstein once called it the eighth wonder of the world. Those who understand and harness it become wealthy. Those who ignore it will work tirelessly for the rest of their lives. For example, if you invest $4,000 USD with an average annual return of 15%, after 5 years, your capital will nearly double. And if you let compound interest work for another 10 or 20 years, that number could grow into hundreds of thousands of dollars, all from starting today. Think about the life you dream of 5 years from now. Do you want to wake up every morning without rushing into traffic? Do you want the freedom to travel with your family, spend time with loved ones, and work on something you're truly passionate about, not just for money? All of that can become reality, but it starts with one decision right now. Will you dare to start investing today? In today's video, I'll accompany you on that journey. We'll explore why early investing matters, the necessary steps to build your 5-year financial goals, the smart investment channels you can join even with small capital, and the year-by-year strategy that shows your clear path to financial freedom. This isn't theory. It's a practical plan that anyone can apply with enough discipline and persistence. My friend, the difference between the rich and the poor isn't their starting point. It's how they choose to act with the money they have. The rich see money as a tool to create more money. The poor see money as something to spend just to get by. That difference might seem small, but after 5 or 10 years, it creates an enormous gap. And if you're watching this video, I believe you don't want to keep living a life of working just to pay off debts or wait for your next paycheck. You deserve a life of freedom, abundance, and prosperity. The next 5 years could be the turning point that changes your entire life. But nothing will begin if you don't dare to plant the first seed today. Like a tree that grows tall and strong after 5 years, you must plant the seed now, nurture it daily, and wait patiently. Financial freedom works the same way. The earlier you plant, the more you'll harvest. So let's start this journey together. Right now. Prepare your mindset. Be ready to learn, ready to act, and most importantly, ready to change your thinking about money and investing. Because when your mindset changes, your actions change and your entire life changes too. And once again, if you find this video helpful, don't forget to like and subscribe to the Bedtime Story Tales channel to spread the message and help build a community of people who dare to invest, dare to grow, and dare to live freely, my friend. When it comes to investing, many people find excuses to delay. They say they don't have enough capital, they lack knowledge, the market is unstable, or they'll wait a few more years. But the truth is, time waits for no one. And every day you delay is a day you lose the chance to make money work for you. Time is the most valuable asset we have, and once it's gone, you can't buy it back at any price. You can lose money and earn it again, lose a job and find another, but lose time, and you lose every opportunity to double or triple your wealth. Imagine two people with the same capital. One starts investing today, the other hesitates for 5 years. Both aim for financial freedom and both work hard, but the results are completely different. The early investor holds a golden advantage because compound interest works longer for them. The one who delays misses out on most of the benefits. After 20 years, the difference between the two isn't just a few percent. It could be double or triple their total assets. The power of compound interest, the eighth wonder of the world, as Albert Einstein said, is the strongest reason to start today. Compound interest simply means money generating more money, profits reinvested to earn even more over time, with growth accelerating as years go by. For example, if you invest $4,000 USD at an average annual return of 15%, after 5 years, it nearly doubles. Leave it for another 15 years, and it could grow to over $60,000 USD. But if you wait 5 years to start, after 15 years you might only have about 30,000 USD. That nearly twofold. Difference doesn't come from your starting capital. It comes from the decision to start early or late. The interesting part is, when you start early, you don't just build wealth, you build knowledge and experience. The first few years are for learning, making mistakes, and growing. The more time you have, the more chances you get to correct yourself. A 25-year-old can take risks, fail a few times, and by 30 they'll have experience and a strong portfolio. But someone who waits until 35, every mistake costs more dearly because they have fewer years to recover. That's why smart people act early. They see mistakes as tuition fees, and they want to pay that tuition while it's still cheap. One common misconception is that you need a lot of money to invest. In fact, the less money you have, the sooner you should start, because time is the only thing that allows small capital to multiply. If you wait until you have a lot of money, you've already lost the opportunity for your small amount today to grow on its own. Suppose a 25-year-old invests $80 USD per month with an average annual return of 12%. By the age of 45, they would have over $80,000 USD. If that same person waits until 35 to start, after 10 years, the amount would be only around $20,000 USD. This huge difference doesn't come from the amount of capital. It comes from starting early or late. Investing today also helps you build healthy financial habits. You learn to spend wisely, to prioritize the future instead of living entirely for the present. You learn self-control against impulsive spending and how to allocate your income between saving and investing. When these habits are formed early, they become part of your personality, helping you progress faster on the path to financial freedom. If you wait too long to start, changing these habits will be much harder. Another factor you can't ignore is inflation. Every year, the value of money erodes bit by bit, and you barely notice until it's too late. $400 USD today can buy many things, but 5 years later, with an average inflation rate of 5 to 7% per year, that purchasing power will shrink significantly. If you let your money sit idle in a low-interest bank account, you're essentially losing money every day. On the other hand, if you invest, the returns you earn can offset inflation, or even surpass it, allowing your wealth to grow in real value. The world is changing fast, and investment opportunities have never been more abundant or diverse, from stocks, real estate, bonds, gold, and technology startups to online businesses. The wealthiest people are those who see opportunities early and act quickly. If you don't start today, you might miss the wealth-building waves of this era. By the time you realize and want to join in, it might already be too late, when markets are no longer attractive and competitors have taken all the opportunities. Let's look at 2 scenarios. Scenario 1. You start investing today with a small amount of capital and patiently learn. After 5 years, you've built a solid portfolio and gained valuable experience. Scenario 2. You keep delaying. After 5 years, you're still in the same place, or worse, struggling because living costs have risen. You've lost opportunities, time, and confidence, and ultimately remain behind in the financial game. The question is, which scenario do you want to belong to? The pioneer or the latecomer? Starting early also helps you reduce risk. It sounds paradoxical, but the earlier you start, the more time you have to diversify your investments, to correct mistakes, and to recover from them. A small failure today is just a lesson, but if you start late, there's no time to fix mistakes, and one wrong move could bring you down. Early investors can weather many financial storms and still stand strong because they have time to recover. And beyond money, investing today is about taking control of your freedom. When you have a stream of passive income, you can choose to do the work you love instead of working just to survive. You can choose where to live, how much time to spend with your family, and what kind of lifestyle you want. In contrast, if you don't invest, 5 years from now you'll still be trading your labor for money, living a life of constraints. My friend, investing today is a declaration that you are taking responsibility for your future. You don't let fate decide, you take the wheel. You sow the seeds today to reap the fruits tomorrow. You put in the effort today to enjoy the rewards later. And above all, you act today so that 5 years from now, you can confidently say, I made the right choice. I took the right actions. And now I'm living the life I dreamed of. Before we talk about which investment channel to choose, how much capital to put in, or what strategy to follow, the most important thing is to define your financial goals for the next 5 years, because without clear goals, every step you take will be random. You might work hard and invest enthusiastically, but end up going nowhere, like a ship sailing without a destination, never reaching any shore. First, understand what financial freedom truly means. It's not just about having a lot of money. It's when your passive income from assets is enough to cover all your living expenses. At that point, you no longer need to work for money. You can choose to work for passion, purpose, or even not at all, and still live comfortably. And that is the destination we aim for in the next 5 years. Financial freedom has several levels. Level 1, financial security. You have enough savings to stay stable even if you lose your job for a few months. Level 2, financial independence. You can live entirely off your passive income without needing to work. Level 3, complete financial freedom. You can do whatever you want, wherever you want, without any financial limitation. You need to determine which level you want to reach in 5 years, because different goals lead to different strategies. Next, you must quantify your goals. Turn your dreams into numbers. Don't just say, I want to be rich or I want freedom. Write down exactly how much you want to have after 5 years, how much monthly passive income you want, and what kind of lifestyle you envision. For example, you might set a goal that in 5 years, you want to have $80,000 USD in investments, at least $800 USD in monthly passive income, and enough savings to travel abroad twice a year. These specific numbers will help you know exactly what actions to take starting today. Here's a simple formula. If you want to reach a certain amount in 5 years, break it down into years, months, and even days. For instance, if your goal is $80,000 USD in 5 years, that means you need about $16,000 USD per year, or about 1,330 USD per month. If your expected average return is 15% per year, you can work backward to calculate how much initial capital you need and how much to add each month. This method turns a seemingly distant goal into a practical and achievable plan. In addition, when defining your financial goals, distinguish between short-term, mid-term, and long-term objectives. Short-term goal, build an emergency fund within 1 year. Mid-term goal, accumulate $20,000 USD in 3 years. Long-term goal, reach $80,000 USD in 5 years. Breaking goals into smaller milestones keeps you from feeling overwhelmed, and every small victory gives you more motivation to keep going. Finally, you must define your risk tolerance. If you're risk-averse, you can choose safer investment channels such as bonds, mutual funds, or a mix of savings and recurring investments, though the returns will be lower. On the other hand, if you're young, have time, and are eager to learn, you can afford to take on higher-risk investments such as stocks, real estate, startups, or even crypto. What matters is that you clearly understand where you stand, how much volatility you can handle, so you can choose goals that truly fit you. Another key point is that your goals must align with your life values. Why do you want financial freedom? Is it to take care of your parents, raise your children, travel the world, contribute to society, or simply to prove your own worth? When your goals connect with deeper personal values, you'll have much stronger motivation to stay persistent, because the 5-year journey won't be easy. There will be moments when you want to quit, and it's the meaning behind your goal that keeps you moving forward. Write your goals down on paper and place them somewhere visible: your desk, your bedroom mirror, or even your phone screen. Seeing your goals daily will remind you why you started, keep you disciplined with your plan, and remind you that every bit you save and every investment you make brings you closer to your free future. Here's a practical example. If you want to have $40,000 USD after 5 years, you could start with $8,000 USD and contribute $400 USD per month with an average annual return of 12%. You'll reach your goal. But if you don't have that initial $8,000 USD, you could start smaller, say $2,000 USD. But then you'll need to increase your monthly contribution to $600 USD, or accept a higher return rate by choosing a more aggressive investment channel. This shows clearly that everything can be calculated. What matters is which path you choose. Financial goals are not fixed. You can adjust them as you move through different stages. But the essential thing is to have a goal from today, because without a destination, you'll drift through life, investing emotionally and ending up nowhere. Remember the famous saying, if you don't have a plan for yourself, you'll become part of someone else's plan, my friend. Defining your 5-year financial goal is the foundation, the roadmap for your investment journey. Start with simple questions. How much money do I want after 5 years? What do I want my life to look like? How much risk am I willing to take? And what will I do today to make it happen? Once you have those answers, you've already taken your first step toward financial freedom. And 5 years from now, you'll thank yourself for daring to write down and chase those goals. When talking about the 5-year financial freedom journey, many people get impatient. They immediately want to know where to invest: stocks, real estate, gold, crypto, or a startup business. But the truth is, if you don't have a solid foundation, no matter which channel you choose, failure is easy. Because investing isn't just about putting money in and waiting for returns. It's a complete system that includes personal finance management, self-discipline, long-term thinking, and risk management strategies. The stronger the foundation, the higher and more stable the financial building you can construct. The first thing you must do is manage your spending. Without spending control, you'll never accumulate capital. And without capital, investing remains just theory. Remember, wealth doesn't start with how much you earn. It starts with how much you keep. Someone earning $2,200 USD a month but spending $2,160 USD is no different from someone earning $400 USD and spending $360 USD. The difference lies in their ability to control spending and accumulate investment capital. Start by tracking all your monthly expenses, from large ones like rent, car payments, and food, to small things like your morning coffee or online impulse buys. You'll be surprised how small costs add up to a large amount over time. Tracking helps you see exactly where your money goes, and only then can you plan to cut unnecessary expenses. The 50-30-20 rule is a helpful framework. 50% for essentials, food, housing, transportation; 30% for personal wants, shopping, entertainment; travel; 20% for savings and investment. If you want to achieve financial freedom faster, you can adjust the ratio, reduce personal spending and increase investments. Some people even follow the 50-20-30 rule: 50% needs, 20% wants, 30% investments. The key is to treat investment contributions as mandatory, not optional. Set aside your investment amount as soon as you receive your income. Don't wait to see what's left, because if you do, there will be nothing left to invest. After controlling expenses and building capital, the next step is to create an emergency fund. This fund covers unexpected situations such as job loss, illness, or accidents. Without an emergency fund, you may be forced to withdraw your investments during crises, ruining your long-term plan. Your emergency fund should cover 3 to 6 months of living expenses. You can keep it in a high-liquidity savings account or another safe channel for quick access when needed. Remember, the emergency fund is not for profit, it's for protection. The next foundation is financial discipline. Investing is not for the impulsive. If you buy because of hot news today and sell because of a price dip tomorrow, you'll never succeed. Financial discipline means knowing your goals, having a clear plan, and sticking to it without letting emotions control your decisions. Many people fail not because they chose the wrong investment channel, but because they lacked discipline. They're easily swayed by rumors or short-term market movements, constantly buying and selling, and in the end, they lose both capital and confidence. Build discipline by setting clear rules and following them strictly. For example, invest at least 20% of your income every month. Never sell an asset because of short-term fluctuations. Only invest in what you truly understand. Another vital foundation is long-term thinking. Financial freedom cannot be achieved overnight. It's the result of consistent accumulation over time. Many people want to get rich quickly, hoping to double their assets in just a few months, and that mindset often makes them victims of scams, Ponzi schemes, or high-risk investments with no real basis. Remember, sustainable wealth requires time, patience, and a long-term mindset. When you patiently sow the seeds and nurture them, you'll reap worthy rewards. Finally, you must learn risk management. No one can predict the future. The market will always fluctuate. What you can do is prepare to minimize risks. The simplest rule: don't put all your eggs in one basket. Diversify your capital across multiple channels so that if one fails, others can protect your assets. Determine the maximum level of risk you can tolerate. For example, don't invest more than 10% of your total capital in high-risk channels, and always keep part of your assets in safe investments to ensure stability. Building a strong investment foundation also means investing in yourself. Knowledge is an invaluable asset. You can lose money in a deal, but if you have knowledge, you'll quickly recover and earn it back many times over. Spend time reading financial books, taking courses, listening to successful investors, and most importantly, practice. Because only when you take action will you truly understand what you've learned. And don't be afraid to start small. When the one small steps you take today will create big results tomorrow. Another crucial point is to build an automated financial system. Separate your investment account from your spending account. Set up automatic transfers each month to your investment account as soon as you receive your salary. This helps you stay disciplined and eliminates emotional decision-making. The more automated your system is, the easier it is to maintain long-term investment habits. Finally, remember that a solid foundation doesn't come from instant perfection, but from starting and improving each day. Today you start tracking your expenses. Tomorrow you create an emergency fund. Next month you open an investment account. Each small step adds up to form a powerful system, and once you've built a solid foundation, every investment channel you choose becomes a tool that helps you move faster toward financial freedom. My friend, after you've built a strong financial foundation, controlled your spending, created an emergency fund, practiced discipline, and developed long-term thinking, the next question is inevitable: where should I invest? This is the moment to explore smart investment channels suitable for beginners, ones that offer good profit potential while helping you gain experience, gradually expand your portfolio, and move closer to your 5-year financial freedom goal. Stocks. This is one of the most popular investment channels today, and also where the power of compound interest shines. When you own a company's stock, you're not just buying a piece of paper, you're becoming a shareholder, a part of that company's growth. If the company grows, you benefit from both dividends and rising stock prices. For beginners, avoid short-term trading or surfing before you have experience. Instead, choose long-term investing, focusing on companies with strong fundamentals, transparent operations, and stable profit growth, and hold for years. History has shown that the stock market consistently delivers superior long-term returns for patient investors. If you're not confident choosing individual stocks, you can invest in ETFs, exchange-traded funds, or mutual funds. These are ideal for beginners since you don't have to pick stocks yourself. The fund diversifies across multiple companies and sectors, reducing risk. While the returns may not be as high as picking the right growth stock, the results are more stable and safer. If you're still learning, ETFs and mutual funds are smart starting points. Real estate. Many people think real estate is only for the wealthy, that you need hundreds of thousands of dollars to get started. In reality, Even beginners with modest capital can participate. You can start by buying small plots of land in suburban areas with future development potential or co-invest with friends and family. You can also invest indirectly through real estate funds or stocks of real estate companies. Real estate's great advantage is that its value tends to increase over time and it's resistant to inflation. However, its drawback is low liquidity. It's harder to cash out quickly when needed. So, allocate wisely. 3. Entrepreneurship and online business. If you have an entrepreneurial spirit, consider starting a small business or online venture. In the digital age, launching an online store on e-commerce platforms or building a personal brand on social media is easier than ever. You can start with a small budget, test the market, learn operations, marketing, and sales. The benefit of running your own business is control. You can generate high profits and potentially turn it into a lifelong career. However, entrepreneurship carries high risks, requiring patience and a learning mindset. So start small, test and scale gradually. Gold and precious metals. Gold has long been considered a safe haven asset, especially in times of economic instability and rising inflation, when prices often surge. However, gold doesn't generate passive income. You only profit when its price rises. Therefore, gold should be seen as a wealth protection tool, not a wealth creation tool. It's wise to allocate 5 to 10% of your portfolio to gold for risk hedging, but don't rely too heavily on it. Bonds, particularly government bonds or corporate bonds from reputable firms, are great for beginners seeking safety. They offer fixed interest rates and are less risky than stocks, making them ideal for conservative investors. However, bond returns are usually modest, and during inflationary periods, their real value can decline. Thus, use bonds to balance your portfolio, combining them with higher risk channels for better overall performance. Cryptocurrency. In recent years, crypto has become a global phenomenon. Some people became millionaires overnight, while others lost everything. Crypto is extremely high risk. Prices can swing by tens of % in just one day. If you're a beginner, be extremely cautious. Invest only a small portion, under 5% of your capital. Use it mainly to learn and gain experience, not to gamble for quick riches. Never borrow money or invest your entire savings in crypto. It can either take you to freedom quickly or destroy you just as fast. Investing in yourself. Less discussed but most important investment channel is yourself. Your knowledge, skills, and health are priceless assets. Use your money to learn a new skill. Take a course, read books, study a language, improve your expertise, or invest in your health through exercise and nutrition. When you become more capable and healthier, you create more opportunities to earn, and that's the highest return. Most sustainable investment of all. Portfolio diversification. When it comes to investing, the key isn't choosing the hottest channel, it's choosing what fits you. Base your decision on your available capital, risk tolerance, and time commitment. Don't follow the crowd. Choose a path you can stay on for the long run. Because investing isn't a sprint, it's a marathon. A golden rule for beginners in capital allocation is diversification. You can apply the 50-30-20 principle. 50% of capital in safe channels like bonds, savings, or mutual funds, 30% in growth channels like stocks or real estate, 20% in high-risk channels like crypto or startups. As you gain more experience, you can adjust these ratios to better suit your personal goals and risk appetite. It is crucial that you never put all your capital into one place, because just one mistake could cause you to lose everything. Remember, there is no such thing as a perfectly safe investment channel. Each has its own advantages and disadvantages. What matters most is knowing what you want, what your 5-year goal is, and which investment path will bring you closer to that goal. For one person, stocks might be the best option, while for another, real estate may be more suitable. Maybe your friends are succeeding with crypto, but you could find success through online business. Don't compare yourself to others. Find your own path. Finally, treat each investment channel as a teacher. It teaches you lessons about capital management, psychology, patience, and risk acceptance. Don't just look at the profits. Look at the value you gain throughout the journey. Because when you've learned enough and grown enough, money will naturally find its way to you. My dear friend, after exploring smart investment channels, the next crucial question is, how can you maintain long-term, sustainable growth instead of only earning short-term profits and losing it all later? Many people may win a few trades, but only those with sustainable strategies truly become successful investors. Wealth doesn't come from a single stroke of luck. It comes from making the right decisions repeatedly over a long period of time. The first strategy you must apply is reinvesting your profits. Remember, compound interest only works at its full potential when you let your profits continue to circulate. If you invest and immediately withdraw your profits to spend, you break the growth cycle. Instead, be disciplined. Reinvest your profits to turn 1 into 2, 2 into 4, and after several years, you'll see your initial capital multiply many times over. This simple rule is the secret behind billionaires like Warren Buffett, who built enormous wealth because he never let his profits sit idle. He made them work to generate more profit. Next is diversifying your investment portfolio. Never put all your money into a single channel, because risks always exist, whether in stocks, real estate, or crypto. Any market can drop unexpectedly. If you invest all your money in one place, you could lose it all. Learn to allocate wisely. Include safe assets, growth assets, and high-risk assets, so that when one market falls, others can stabilize your portfolio. Diversification is your shield on the road to financial freedom. Another key factor is risk management. Always set loss limits for every investment. For example, you can set a rule to never lose more than 10% of your capital on any trade, or not to invest more than 5% of your total assets into high-risk ventures. Risk management won't prevent losses, but it ensures that no loss will ever destroy you. Remember, in the journey to wealth, protecting your capital is more important than making profits, because as long as you still have capital, you still have opportunities. Once you lose it all, you lose everything. The next strategy is patience and long-term thinking. Markets always fluctuate, sometimes up, sometimes down, and no one can predict short-term movements accurately. But in the long run, growth trends always prevail. The U.S. stock market over the past 100 years has gone through countless crises, wars, and recessions, yet it has always risen over time. Real estate, too, may freeze temporarily, but over decades its value continues to grow. Patience is the weapon of a smart investor. You don't need to win every month or every year. You just need to win over the course of your journey. To achieve sustainable growth, you must keep learning and updating your knowledge. The world changes rapidly. Today's opportunities may disappear tomorrow. If you stop learning, you'll fall behind. Read books, take courses, follow financial news, listen to successful investors, and most importantly, learn from your own experiences. Every right or wrong decision is a valuable lesson. Write it down, analyze it, and improve. The more you learn, the wiser you become. And the wiser you are, the more effectively you invest. Another strategy for sustainable growth is controlling your emotions. Many investors lose money not because they choose the wrong investment, but because they let emotions take over. They panic when the market drops and become greedy when it rises, buying high and selling low. To avoid this, have a clear plan and stick to it. Set buying and selling rules before you invest and stay disciplined. Don't let rumors or short-term volatility shake your decisions. Emotion is the #1 enemy of sustainable growth. Additionally, apply the principle of passive income instead of relying solely on asset price appreciation. Focus on investments that generate regular cash flow. For example, rental properties, dividend-paying stocks, profit-distributing funds, or online businesses that produce monthly income. Passive income gives you a stable source of cash to reinvest, while reducing financial pressure in your life. With steady cash flow, you won't need to sell assets when the market drops. And this is the key to long-term portfolio sustainability. Another important point is flexibility and adaptability. Sustainability doesn't mean rigidity. Markets and economic environments change, and you must adjust your strategy accordingly. For example, when bank interest rates rise, you might allocate more to bonds or savings accounts. When technology booms, you could explore new sectors like artificial intelligence or renewable energy. Flexibility allows you to seize new opportunities while maintaining safety. To ensure long-term growth, practice consistent accumulation over time. Set aside a portion of your income for investment every month, regardless of whether the market is up or down. This is known as the dollar-cost averaging method. It helps you avoid the risk of investing all your money at once and, in the long run, gives you a better average buying price. This method is simple, effective, and especially suitable for beginners, as it removes emotional bias and market timing. Finally, remember that a sustainable growth strategy lies not only in numbers, but also in your mindset and lifestyle. Maintain a simple lifestyle. Don't rush to increase spending when your income grows. Reinvest most of your profits instead of spending them. Stay humble, keep learning, be patient, and stay disciplined. Because true wealth isn't just the money you accumulate, it's the person you become along the way. My dear friend, to achieve financial freedom in 5 years, you can't just set a goal and wait. You need a clear roadmap for each stage each year, like building a house with a detailed blueprint and step-by-step construction. Only then will you see results after 5 years. Without a plan, you'll get lost among countless choices, lose patience, or give up halfway. Let's break down this 5-year journey so you'll know exactly what to do each year. Year 1. Learn, accumulate, and start small. The first year of your journey is the foundation. Your main goal is to build financial habits and start learning how to invest. Carefully track your income and expenses, cut unnecessary costs, build an emergency fund covering 3 or 6 months of living expenses, and allocate at least 20% of your income to investments. Don't focus too much on profits in the first year. Treat it as a time to learn and experiment. You can start with stocks through ETFs, savings accounts, or mutual funds. With small capital, your priority is to understand how the market works and build discipline. This is also the time to invest in yourself. Read finance books, take courses, and develop a strong mindset. Knowledge capital brings longer-term returns than any other investment. Year 2. Accelerate, expand, and diversify. After becoming familiar with financial management and small-scale investing, the second year is when you should increase your investment ratio. If you invested 20% of your income in the first year, raise it to 25-30% this year. Start diversifying. Besides ETFs, consider a few fundamental stocks, small real estate opportunities, or an online business. This is the year to explore different channels to find what best fits you. What's crucial is that you continue following your risk management principles. Don't put all your money in one place, and keep learning from experience. The second year is also when you should start generating small cash flows from your investments. Even if the returns are small, they give you the motivation to keep going into the third year. Reinvest and build passive income streams. This is a pivotal year. The goal is not only to grow your capital, but also to create consistent passive income. You can reinvest profits from stocks, expand your portfolio into rental real estate, or buy dividend-paying stocks. If you run a small business, focus on optimizing it to create stable cash flow rather than just chasing sales revenue. Passive income is the key that leads you to financial freedom. Because when you have steady cash flow, you have both capital to reinvest and peace of mind, knowing you won't have to sell assets during hard times. The third year is also the time to strengthen your discipline and control your emotions, because this is when many people get caught up in the ambition to grow too fast. Always remember, sustainability is more important than speed. Year 4. Optimize, reduce risk, and increase assets. After 3 years, you now have a meaningful portfolio. At this stage, your strategy should shift from focusing on fast growth to optimizing and protecting your wealth. Review your entire portfolio, eliminate underperforming channels, reduce exposure to high-risk investments, and increase your allocation in safer assets such as stable real estate, bonds, or blue-chip stocks. This is also the time to strengthen your passive income and improve liquidity so that even during economic volatility, you remain secure. At the same time, continue investing in yourself, because as your assets grow, your responsibility to manage them also increases. You need knowledge to manage your wealth wisely. Year 5. Harvest and step into financial freedom. After 4 years of planting and nurturing, the 5th year is when you'll see tangible results. If you've stayed disciplined and followed your plan, this will be the year you achieve financial freedom. Your passive income, from dividends, real estate, or business, will be enough to cover your living expenses. You might choose to reduce your workload, spend more time with your family, travel, or start passion projects you've always dreamed of. This is also the year to maintain discipline. Don't overspend just because you now have more money. Instead, continue reinvesting and optimizing, because financial freedom is not the end, it's the beginning of a new chapter, where you live life on your own terms. My dear friend, breaking your 5-year journey into clear yearly milestones gives you a solid roadmap, removing all the uncertainty. You'll know exactly what to do each year and what to focus on. When you stay consistent, you'll realize that financial freedom isn't a distant dream. It's a fully achievable goal. If you start today and follow the right plan, 5 years from now you'll be amazed at how much you've changed. My friend, theory may give us formulas, numbers, and strategies, but it's real human stories that truly move us and awaken belief. Because when you hear about someone who started from nothing, faced hardships, persevered, and succeeded, financial freedom no longer feels impossible. It becomes something entirely attainable, as long as you dare to begin. Imagine the story of a young man named Michael. Michael didn't start with any advantage. He came from an average family, earning just enough to get by. After graduating from college, he got a job with a salary of about $350 a month. His friends complained that it wasn't enough to do anything, saying they should wait until they earned more before thinking about investing. But Michael was different. He learned about the power of compound interest and read the famous quote, "The best time to plant a tree was 20 years ago, the second best time is now." So he decided that no matter how little he had, he would start. In his first year, Michael invested only around $80 a month into savings and mutual funds. The amount was small, too small to make a visible difference, but what mattered was that it built discipline. Instead of spending all his salary, he learned to prioritize his future. He spent his evenings reading finance books, learning from seasoned investors, and recording every expense to track his money. His friends laughed, saying that such small investments were meaningless. But Michael believed that in 5 years, they would see the difference. By the second year, he increased his monthly investment to $120, then $200. He learned how to analyze companies and bought a few blue-chip stocks, while also looking into small plots of land on the city's outskirts where infrastructure was developing. Michael didn't rush. He researched carefully, sought advice from experienced investors, and bought a small piece of land worth around $4,000, partly funded by family support. It was his first asset outside his job. In the third year, when the stock market fell and many people panicked and sold, Michael stayed calm. Remembering his long-term principles, he didn't sell. In fact, he bought more at lower prices. Meanwhile, the land he had bought began to appreciate as new roads were built nearby. He decided to hold it for the long term rather than selling quickly, wanting it to become a stable asset. That same year, he started a small online business, selling products through social media. The profits were modest, just a few $dozen a month, but they gave him confidence and experience in creating multiple income streams. In the fourth year, the combined cash flow from his investments and online business gave him enough capital to buy another small plot of land. This time, he partnered with a friend. They pooled resources, shared risks, and split profits. He also bought more dividend-paying stocks, receiving small quarterly payments. The feeling of money flowing into his account without active work motivated him even more. He knew he was on the right path. By the 5th year, Michael couldn't believe his eyes. From a young man earning $350 a month after 5 years, he had built a stock portfolio worth over $20,000, 2 pieces of land that had doubled in value, and an online business generating steady cash flow. More importantly, he had developed discipline, knowledge, and unshakable confidence that financial freedom was absolutely achievable. His friends who once mocked him were now asking for his investment advice, and his family felt proud that Michael had changed the course of his life. Michael's story is not unique. There are countless ordinary people, just like you and me, who started with small capital but, through persistence, discipline, learning, and early action, completely transformed their lives within 5 years. An office worker with a salary of only $320 per month managed to invest $80 each month in an ETF fund. After 5 years, she accumulated nearly $8,000. In addition, by purchasing a small apartment for rent, she earned an extra $200 in passive income each month. It wasn't a huge amount, but it was enough for her to feel secure, confident, and free from financial stress. Another example is an engineer who used to spend most of his salary on gaming. After losing his job, he decided to change. He began tracking his expenses, saving 30% of his income, investing in stocks, and learning programming. In just 5 years, he not only built assets worth nearly $40,000, but also gained a freelance job that doubled his previous income. He realized that investing wasn't just about money, it was about transforming himself. As you can see, all these stories have one thing in common. They took action today. They didn't wait to earn more money or for the perfect conditions. They started with what they had, small but consistent steps. And that consistency created great results after 5 years. My friend, when you hear these stories, you might wonder, can I do it too? The answer is absolutely yes, because these people once doubted themselves just like you. They were once short on money, worried and afraid to fail, but they overcame it by simply starting. And once you start, you'll realize the path isn't as hard as you thought. The most important question is whether you dare to take that first step. So treat these stories as inspiration. Let them ignite your belief that financial freedom isn't a far-fetched dream, but a realistic goal within reach. If they can do it, you can too. All you need is to start today and stay consistent for the next 5 years. One day you'll be the one sharing your own story, inspiring others on their journey. My friend, we've walked together through an entire roadmap. From understanding why you must invest now, setting a 5-year financial goal, building a strong foundation, choosing smart investment channels, applying sustainable growth strategies, creating annual action plans, and listening to real stories from ordinary people who achieved financial freedom through perseverance. All of this isn't just theory. It's a map, showing you exactly what path to take and giving you the confidence that if you stay determined, you will absolutely reach your destination. The most important message I want to leave you with is this. Start investing today. 5 years from now, you'll be financially free. You don't need a huge starting capital. You don't need to be a genius. You don't need special luck. The only thing you need is the decision to act, to plant the first seed for your future. Time will do the rest because the power of compound growth, discipline, and patience will turn small steps today into massive results tomorrow. Think about your life. Where were you 5 years ago? What were you doing? You probably feel that time passed faster than you imagined. 5 years from now will be the same. So ask yourself, where do you want to be in 5 years? Still struggling paycheck to paycheck? Or smiling because you've achieved financial freedom? Everything depends on the decision you make today. If you start now, 5 years from now, you'll thank yourself. But if you keep delaying, 5 years from now, you'll regret not starting sooner. My advice, start with the smallest step possible. It could be setting aside 10% of your income for investing, opening a mutual fund account, reading a personal finance book, or simply tracking your expenses daily. These small actions are the first bricks that will build your financial freedom. Don't wait until you have more money. Don't wait for the perfect market conditions, because that perfect moment will never come. The best time is always right now. Remember, on this journey, you'll face challenges. The market will go down, your assets may lose value, and there will be times you feel discouraged and want to quit. But those are the moments that help you grow stronger. Don't let small setbacks make you abandon your entire path. Always return to your 5-year goal. Trust in the power of discipline, and believe that every dollar you invest today is quietly working for you. And don't forget, money is just a tool. Financial freedom isn't the ultimate goal. It's the means to live a more meaningful life. When you no longer worry about money, you'll have time for family, friends, passion, and health. You'll live the life you truly want, and that's the real wealth. Before we end, I want to remind you of one thing. Share this mindset with others. Let's build a community of people who know how to invest, grow wealth, and live freely. Because when you share knowledge, you not only help others but also strengthen your own belief and discipline. And if you find this message valuable, please like and subscribe to Bedtime Story Tales so we can continue this journey together. Learning, investing, and walking hand in hand toward financial freedom. My dear friend, 1 year is neither too long nor too short, but it's enough to change a person's life. Start planting your seeds today. Nurture them every day. Stay patient and persistent. And 5 years from now, you'll harvest freedom, happiness, and prosperity. And one day, you will be the one inspiring others who are just beginning their own journey.